Money sitting in a bank account feels solid, almost like it's locked away somewhere safe, untouched and waiting. Most people picture banks as giant storage systems where cash goes in, stays protected, and then gets passed along when someone else needs a loan. It sounds simple, clean, and completely logical. But that's not actually how it works. Banks don't wait around for deposits before giving out loans. When a loan gets approved, something far more interesting happens. Instead of pulling money from an existing pile, the bank simply adds numbers to the borrower's account. Just like that, new money appears. No physical cash changes hands. No vault gets opened. It's just a digital entry that didn't exist a moment earlier. That idea alone flips the usual understanding of money on its head. Imagine a small group of people depositing money into a bank. 10 individuals each deposit $1,000, bringing the total to $10,000. That money sits in their accounts, visible, stable, and seemingly untouched. Now someone walks in and gets approved for a $1,000 loan. The natural assumption is that the bank takes $1,000 from those deposits and hands it over. That's not what happens. Instead, the bank creates a brand new $1,000 in the borrower's account. Now the system shows $11,000 in total deposits. The original $10,000 is still there, unchanged, and the borrower now has access to an additional $1,000 that didn't exist before. At first, this sounds almost too strange to be real. If banks can do that, it raises an obvious question. Why not just keep creating money endlessly? The answer starts to become clearer when looking at what happens after that money gets used. Money doesn't just sit in the borrower's account forever. It moves. It gets spent, withdrawn, or transferred. And every time that happens, the bank has to deliver something real in return. If part of that loan is withdrawn as cash, the bank has to provide actual physical bills. If the money gets transferred to someone using a different bank, something else happens behind the scenes. The bank must send reserves to settle that transaction. Reserves are a layer most people never see. They aren't the money used in everyday spending. They exist within the banking system itself, used by banks to settle payments with each other. When money moves across banks, reserves move in the background to balance everything out. So while a loan can create new deposits, it also creates obligations. The bank now has to be ready to meet withdrawals and transfers. That means maintaining enough cash and enough reserves to keep everything running smoothly. Think of it like a system that constantly needs to stay balanced. Money flows out as people use it, and the bank needs to handle that flow without running dry. Now imagine that borrowers start spending the $1,000. Maybe $300 is withdrawn in cash. That immediately reduces the bank's physical cash holdings. Then the remaining $700 gets transferred to someone who banks elsewhere. That means $700 in reserves must be sent out to another bank. Even though the loan created new money, the bank now has fewer resources available. This is where the idea of unlimited money starts to fall apart. Banks can create deposits, but they can't ignore the consequences that follow. Every dollar that leaves the bank, whether as cash or reserves, puts pressure on its ability to keep operating normally. That's why lending decisions are never random. Every loan carries risk, not just because of repayment, but because of what happens when the money leaves the system. If too much money flows out too quickly, the bank can run into trouble. It may struggle to meet withdrawal demands or settle transactions with other banks. And then there's the question of repayment. When a borrower eventually pays back a loan, the bank doesn't just gain everything as profit. If someone borrows $1,000 and repays $1,200, it might seem like the bank just earned $1,200 out of nothing. But that's not how it works. The bank already lost access to the original $1,000 when it was withdrawn or transferred. Getting that money back simply restores what was lost. The actual profit is the extra $200 in interest. That interest is what makes lending worthwhile. It compensates the bank for the risk taken and the resources used when the loan was issued. But lending isn't the only way banks make money. They also invest in relatively safe assets, like government bonds, generating steady returns over time. This helps balance the risks that come with issuing loans. Because not every borrower pays back what they owe. When someone fails to repay a loan, the bank doesn't just erase that loss. The money is already left in the form of cash withdrawals or transfers. That loss becomes real, and it has to be covered. This is where capital comes into play. Capital is essentially the bank's own financial cushion, separate from customer deposits. It's money provided by owners and shareholders, designed to absorb losses when things go wrong. If too many borrowers fail to repay, that capital starts to shrink. Without enough capital, Even a relatively small number of bad loans can create serious problems. And alongside capital, there's another critical factor: liquidity. Liquidity is all about how easily a bank can access cash or reserves when needed. Even if a bank appears financially strong overall, it can still run into trouble if it can't quickly provide money when customers ask for it. This becomes especially important during periods of uncertainty. If people start worrying about the safety of their money, they may rush to withdraw it all at once. This creates a situation known as a bank run. The bank may not have enough cash available immediately because much of its money is tied up in loans or long-term investments. As withdrawals increase, pressure builds. If the bank can't keep up, it risks collapsing. And the effects don't stop there. When one bank faces trouble, fear can spread quickly. Customers at other banks may start to worry that their money is also at risk. That fear can trigger more withdrawals, more stress on the system, and potentially a chain reaction that affects multiple banks at once. To prevent this kind of collapse, central banks and governments sometimes step in. They may provide emergency support, limit withdrawals, or temporarily close banks to stop panic from spreading. These actions are meant to stabilize the system, but they also highlight how fragile things can become when confidence disappears. At this point, it might feel like a strange system to rely on. If money can be created through lending, and if that process carries risks, why use it at all? The answer comes down to how modern economies function. Growth depends heavily on access to credit. Businesses need loans to expand operations, hire employees, and invest in new opportunities. Individuals rely on borrowing to purchase homes or fund major expenses. Governments also borrow to support large-scale projects and manage spending. Without a system that allows money to be created through lending, all of this would move much slower. Every loan would depend entirely on existing savings. That would limit how quickly money could circulate and how fast economic activity could grow. By allowing banks to create money through loans, the system speeds things up. It enables investment, expansion, and development on a much larger scale. But that speed comes with a trade-off. When lending increases too quickly, money floods into the economy. This can push prices higher, especially in areas like housing or financial markets. At first, it may look like strong growth. Asset values rise, borrowing continues, and confidence remains high. But underneath, pressure starts to build. If too much money is created without enough real value to support it, the system becomes unstable. Borrowers may struggle to repay. Banks may face increasing losses. What once looked like rapid growth can turn into a fragile situation. And because banks are deeply connected through financial networks and reserve systems, problems don't stay isolated. They spread. This interconnected structure is what makes the system both powerful and vulnerable at the same time. Everything depends on balance. Lending drives growth, but too much lending creates risk. Stability relies on trust, but trust can disappear quickly when uncertainty rises. And all of this happens beneath the surface, largely unnoticed. Most people continue to see banks as simple storage institutions, holding money safely and lending it out when needed. The deeper mechanics remain hidden, even though they shape the entire economy. That's why this topic rarely gets attention. It doesn't feel urgent on the surface. Transactions work. Balances update. Everything appears normal. But behind that simplicity is a system constantly creating, moving, and managing money in ways that aren't immediately visible. And once that becomes clear, the idea of what a bank actually does starts to look very different. The idea that banks can create money often gets simplified into something that sounds almost magical. Numbers appear in accounts, balances increase, and it feels like value has been created out of nothing. But behind that process, there's a constant tension holding everything together. Every time a bank issues a loan, it's making a decision that stretches into the future. That newly created money doesn't just sit still. It moves through the economy, changing hands, flowing between accounts, and eventually returning, or not returning, depending on how things play out. And that, or not, is where things start to matter. Because when loans don't get repaid, the consequences aren't theoretical. The bank already allowed that money to leave. It may have gone into someone's pocket as cash, or into another bank through a transfer. That means the loss is real, and it has to be absorbed somewhere. This is why capital plays such a critical role. Capital is the bank's own financial safety net. It's separate from customer deposits and acts as a buffer when things go wrong. When borrowers default on loans, capital is what takes the hit first. Without enough of it, even a relatively small wave of defaults can create serious instability. But capital alone isn't enough to keep everything running smoothly. Liquidity becomes just as important, especially in moments when timing matters more than totals. A bank might look strong on paper, holding plenty of assets in the form of loans or investments. But if those assets can't be quickly turned into cash, problems can appear almost instantly. Because customers don't wait. When someone wants to withdraw money, the expectation is immediate access. The same goes for transfers. Money needs to move quickly, and the bank has to be ready to meet that demand at any moment. If too many people decide to withdraw funds at the same time, the bank faces pressure from all sides. Cash reserves start to shrink. Transfers drain reserves that are needed to settle payments with other banks. And if that pressure builds faster than the bank can respond, the situation can spiral. This is how bank runs begin. It starts with concern, sometimes triggered by news, rumors, or uncertainty. A few customers decide to withdraw money, just to be safe. Then more people follow. The pace increases, lines form, digital transfers spike, and suddenly, the bank is dealing with a wave of withdrawals that it wasn't designed to handle all at once. Even a healthy bank can struggle under those conditions, because the system is built on the assumption that not everyone will demand their money at the same time. Loans are long-term, deposits can be withdrawn instantly. That mismatch creates vulnerability. And when one bank begins to show signs of stress, the effect rarely stays contained. Fear spreads quickly through financial systems. Customers at other banks begin to wonder if their money is safe. Withdrawals increase across multiple institutions. Pressure builds everywhere at once. This chain reaction can turn a single problem into a widespread crisis. That's why central banks and governments often step in during these moments. They might provide emergency funding to banks, ensuring they have enough liquidity to meet withdrawal demands. They might guarantee deposits up to a certain amount, reassuring customers that their money is protected. In extreme cases, they may even limit withdrawals or temporarily close banks to prevent panic from escalating. These actions are designed to restore confidence, because confidence is what keeps the system functioning. Without it, even a well-structured financial system can start to break down. And this brings everything back to the core idea. Money isn't just something that exists. It's something that is constantly being created and managed through a network of trust, decisions, and constraints. When banks lend, they expand the money supply. When loans are repaid, that money effectively shrinks. When loans default, losses ripple through the system. And when lending slows down, the entire economy can feel the impact. This constant expansion and contraction is what shapes economic cycles. During periods of optimism, lending increases. Banks feel confident approving loans. Borrowers feel confident taking them. Money flows more freely, fueling growth. Businesses expand. Spending rises. Asset prices climb. But that same momentum can lead to excess. If too much money is created too quickly, it can push prices beyond sustainable levels. Housing markets overheat. Financial assets become inflated. Debt levels rise. Everything appears strong on the surface, but underneath, the system becomes more fragile. Eventually, something shifts. It could be rising interest rates, slowing growth, or increasing defaults. Whatever the trigger, confidence begins to weaken. Banks become more cautious, lending standards tighten. Borrowers pull back, and the flow of new money slows down. When that happens, the effects spread quickly. Businesses that relied on easy credit may struggle to continue expanding. Consumers may cut back on spending. Asset prices may start to fall. What once felt like growth begins to reverse. And because money creation is so closely tied to lending, this slowdown can feel like the entire system is losing momentum. But it's not money disappearing in a physical sense. It's the pace of creation changing. That distinction is subtle, but important, because it explains why economic shifts can feel sudden even though they've been building over time. The underlying mechanics are always in motion, but they remain mostly invisible until something disrupts the balance. And that invisibility is one of the main reasons this topic isn't widely understood. From the outside, banking feels simple. Deposits go in, payments go out, balances update. Everything appears stable and predictable. There's no obvious moment where money is created, no visible signal that something new has entered the system. So the deeper process goes unnoticed. People continue to think of banks as passive institutions, holding money rather than actively shaping its supply. But in reality, banks are constantly influencing how much money exists, where it flows, and how it impacts the broader economy. They're not just storing value, they're participating in its creation. And that role comes with responsibility. Every lending decision carries weight. Approve too many risky loans, and the system becomes unstable. Restrict lending too much, and economic growth slows down. Finding the right balance is an ongoing challenge, influenced by regulations, market conditions, and human judgment. Even with rules in place, no system is perfect. That's why financial cycles continue to happen. Periods of growth are followed by corrections. Stability is followed by stress. And through it all, the process of money creation continues, shaping the direction of the economy in ways that aren't always obvious. So when someone says banks create money out of thin air, there's a hint of truth there, but it's incomplete. Yes, money is created through lending, but it's created within a system that has limits, risks, and consequences. Cash can leave, reserves can drain, loans can fail, capital can shrink, liquidity can tighten. Each of these factors acts as a boundary, preventing the system from expanding without control. And understanding those boundaries changes the way everything looks. Money stops being just a static thing sitting in an account. It becomes part of a dynamic system, constantly moving, growing, and adjusting based on countless decisions happening behind the scenes. Banks become more than just storage facilities. They become central players in shaping economic activity, and the entire system starts to feel less like a simple machine and more like a living network, constantly adapting to new conditions. That's the part most people never learn. Not because it's hidden intentionally, but because it's easy to overlook. The surface is simple. The deeper layers take time to explore. And without that exploration, the true nature of money creation remains out of view. But once it's understood, even at a basic level, it becomes easier to make sense of the bigger picture. Why economies grow the way they do, why financial crises happen, why lending matters so much, and why the balance between risk and stability is always being tested. Because at the center of it all is a system that doesn't just move money around, it creates it. And that changes everything. If this made the system clearer and helped break down something that usually feels complicated, consider liking the video and subscribing for more content that explores how money, banks, and the economy really work.